There's this huge, glaring contradiction right at the heart of modern finance, and it's all about ESG investing. You've heard the headlines, right? It's under attack, it's failing, it's become this political football. But at the very same time, the amount of money tied up in it is just staggering. So let's dive into this paradox.
First, let's just wrap our heads around the sheer scale here. As of early 2025, the total value of assets in global ESG funds is a massive 3.16 times trillion dollars. I mean, we're not talking about some niche corner of the market. This is a core part of the global financial system.
But, and here's where the plot thickens. In the first quarter of 2025, those very same funds saw record outflows of $13 billion. It was actually the first time European funds saw a net outflow since 2018. So you've got this multi-trillion-dollar giant on one hand, and on the other, investors are pulling money out faster than ever before. And that brings us to the big question we're tackling today. Is this the end of ESG as we know it? Or are we just watching it go through a really painful, very public, and frankly, a very necessary transformation?
To get to the bottom of that, we've really got to dig into the fundamental tensions at the heart of ESG. The gap between its performance, what it promises, and its very, very real credibility problems.
So let's talk performance. In the first half of 2025, sustainable funds actually came out on top. They delivered a 12.5% median return, which was their best run since 2019, beating traditional funds. But, and this is a huge but, this comes right after a period where they were underperforming. So what that tells us is that outperformance isn't a sure thing. It's cyclical.
Okay, and a huge part of this whole credibility mess, it's greenwashing. Take Australia, for example. Regulators there fined Mercer because its Sustainable Plus fund, which said it was fossil fuel-free, actually held stock in 15 fossil fuel companies. Vanguard got hit for something similar. And look, this isn't just a one-off thing. While the total number of cases actually dipped in 2024, the severity of those cases shot up by 30%. Regulators aren't just sending warnings anymore. They're bringing the hammer down. All this pressure from regulators has led to this really weird kind of backward result. Green hushing. Companies like Anheuser-Busch InBev, they didn't ditch their net zero goals. They just stopped talking about them. And why? To dodge the legal and political crossfire. It's this retreat into silence, and it's all driven by fear. And maybe the biggest problem of all, the one that's happening inside the ESG world itself, is the data. You can have major rating agencies look at the exact same company and come to completely different conclusions. MSCI, for instance, grades companies on a curve against their industry peers. It's a relative approach. But then you have Sustainalytics, and they use an absolute risk model. Two totally different philosophies. And this quote just nails the problem perfectly. Under that relative model from MSCI, an oil and gas company can actually get a top AAA rating just by being a little bit better managed than the other oil and gas firms. But under the absolute model from Sustainalytics, that same company is flagged as high risk simply because of what it does. I mean, for an investor, how are you supposed to make sense of that? It's total chaos. And this confusion, it's not just stuck in some spreadsheet. It's now baked into global policy, creating this massive split in how different parts of the world are handling this, especially between Europe and the United States.
If you look at Europe, man, they are hitting the gas pedal. You've got the Corporate Sustainability Reporting Directive, or CSRD, covering 50,000 companies. Then came the Due Diligence Directive, the Deforestation Regulation, and even brand new, really strict rules on how you can even name an ESG fund. The message from Europe is crystal clear. More rules, more disclosure, more enforcement. Period. But then you hop across the pond to the United States, and it's a completely different story. With the return of the Trump administration in 2025, we've seen the SEC's big climate disclosure rules put on ice and a much wider political backlash. And in response, some of the biggest names in finance, we're talking JP Morgan, State Street, have pulled out of the Climate Action 100+ investor group. They're essentially choosing to sidestep political fights rather than make public climate promises. All right, so you've got this political mess, you've got regulatory chaos. You'd think the money would be running for the hills, right? Well, if we stop listening to the headlines and start following the money, a totally different picture emerges. It's like this quiet revolution happening right under the surface. Despite those short-term outflows we talked about, the long-term forecast is, well, it's pretty mind-blowing, honestly.
The global ESG market is projected to grow from around $35 trillion today to over $167 trillion by 2034. That's a compound annual growth rate of nearly 19%. The money isn't leaving, it's just getting ready for the long game. In fact, by 2025, assets that have some kind of ESG mandate are expected to make up half of all professionally managed investments on the entire planet. Let me say that again, half. This isn't some side hustle for investors anymore. It's fast becoming the main event. And if you need even more proof, just look at the bond market. The amount of sustainability-linked bonds, that's debt tied to hitting specific ESG targets, grew 15-fold between 2019 and 2023. That shows a deep, mainstream acceptance right in the plumbing of the financial system, a world away from the political squabbles. Okay, so the market is huge, it's messy, and it's still growing. What does any of this actually mean for you as an investor? Let's try to break down a practical way to think about this whole landscape. First off, you gotta understand that ESG investing isn't what it used to be. It's grown up. It started with really simple stuff like exclusion, just avoiding so-called sin stocks like tobacco. Then it moved to picking best-in-class companies. But now, the really sophisticated strategies involve integrating ESG data right into financial models and even actively engaging with companies to push for change. So for most of us today, it really boils down to three main ways you can play this. You've got negative screening, where you just exclude industries you don't want to be in. Then there's ESG integration, where you treat this data as just another tool to spot financial risks and opportunities. And finally, there's thematic investing, where you specifically target big trends like clean energy or water scarcity. So, if you're building your own toolkit for this, what do you need? First, focus on materiality. Ask yourself, which ESG factors actually hit a company's bottom line? For an oil company, it's probably carbon emissions. For a tech company, it could be data privacy. Second, understand those rating systems we talked about. Are you looking at a relative score or an absolute one? Third, always remember to balance your ESG goals with good old-fashioned diversification. And finally, look at a company's trajectory. Are they getting better over time? That can matter a lot more than their score right now. So here's the bottom line, the big takeaway from all of this. The real enduring case for ESG, once you strip away all the marketing hype and the political attacks, isn't about virtue signaling or feeling good. It's a framework for pricing risks. Risks like climate change, supply chain problems, or regulatory shifts that traditional financial models have, for the most part, just ignored. And that really leaves us with one final big question. For all its flaws, the entire journey of ESG has been this multi-trillion-dollar attempt to get better at pricing long-term risk. And so the real question isn't whether ESG is good or bad. It's this. As these risks become more and more real, what is the long-term cost of ignoring them?